Shares of First Republic spiraled on worse than expected earnings. Deposits declined by $72 billion during the first quarter as banking chaos spooked customers. Joining us now with his outlook on the regional bank's future is David Chiaverini, Wedbush Securities Managing Director here. David, great to have you here with us this morning. When you think about what we saw within the quarter, of course, this really accounting for that banking chaos that took place and how hard it hit First Republic. The company didn't really give time to take questions, no time to take questions really. And then at the end of it, they still have so much to answer for with regard to the $30 billion infusion that they've also received from a consortium of banks. So what are the next steps as communicated by the company to the understanding right now?
Yeah, there's a lot of unanswered questions, but the next steps really are them reducing headcount. They mentioned about 20 to 25%. I view this as kind of round one of multiple rounds that very well could occur. Attrition could also help reduce expenses, and they also mentioned about reducing their real estate footprint. Now, interestingly, they mentioned about pivoting to an originate and sell model from an originate and hold model. Now, that is more capital efficient, but it is less profitable for the company. So we did lower our EPS estimates following the print. The net interest margin, of course, is getting hammered with all of the borrowings that they had to take on to offset all of the deposits that left the bank. So our estimates are coming down, and really it's becoming a play on tangible book value, because with earnings likely to be negative for the foreseeable future, investors can really only hang their hat on a discount to tangible book value and coming up with a valuation for the company.
David, so we know that this company's profitability is really going to be challenged, as you were just outlining. Do we have to worry about First Republic's ability to survive, or is that not really in question here?
Yeah, it's not really a question now because of the unprecedented actions that the Treasury and the Federal Reserve put in place right after SVB went down. They're now enabling banks to pledge loans and securities at par and getting borrowings in return. So from a liquidity standpoint, they are just fine. And then the next thing to look at is their regulatory capital ratios. And they're holding in there as long as they don't sell their loans and they don't sell those securities and realize the losses that are embedded in their balance sheet, or realize the unrealized losses that are embedded in their balance sheet. So that gives them a long leash to survive and try and kind of wade through the difficult environment over the next several quarters.
How does that environment kind of perspire over into some of the other banks, the regional banks too? Do they look at this release, especially some of the actions that First Republic is taking specifically on the workforce reduction? Do they look at something like that and say that's, First Republic specific, or do they say, all right, this is also a time where we ourselves might need to also adjust our own headcount or operating structure?
This is a very, very much an idiosyncratic situation for First Republic. But with that said, deposit competition is becoming that much more intense. First Republic is offering CD rates at 4.95%. Let's just call it a 5% CD rate. Other banks are going to see that and say, okay, we need to increase our deposit costs as well. And then there's the competition from money market funds that are providing yields in the same neighborhood. So deposit costs are going to be going up significantly for the banking space, and that's going to weigh on net interest margins across the industry. So that would be the big read-through to other banks from First Republic.
David, I do want to get back to the bigger space, but I do have one more question about First Republic, and that has to do with the conference call and the lack of questions that were able to be asked on the conference call. Was that a failure on management's part to not allow questions? Do you think that they have handled that well, and for that matter, have handled this crisis all along well?
It wasn't surprising, at least from my perspective, that they did not take Q&A. In fact, I wouldn't have been surprised if they had pre-recorded the conference call ahead of time and also not taking questions because of how unprecedented the backdrop is. They're not going to do, there's really no upside for them to take questions, especially in this environment where, their viability is at stake. So their general counsel very well may have said, let's not do a Q&A session because then they won't be in position of saying anything essentially too positive that might not turn out to be the case.
So sorry to broaden it out once again then and talk about the sector more broadly. As you said, if you're going to get this deposit competition, right, if you're going to get probably limits on profitability, not just for First Republic or some of its closest peers, but across the industry, how do you decide what to buy now? Are there good buys? Are there attractive stocks to be bought among the regionals right now?
Yeah, so our view is look at the defensive names. So the ones that do have a high level of insured deposits, those that can lock in a higher net interest margin despite the potential for, if the Fed does pivot and start reducing interest rates. So we're looking at companies like Fifth Third Bank, Regions Financial, M&T Bank, New York Community Bank. The one that we recently upgraded that has a little bit higher risk, but also higher return potential is Western Alliance, because they're showing a rebound in deposits after seeing a significant decline during the quarter. So there is a way to get exposure to the banks, but from a big picture perspective, I am expecting pressures across the industry for the next several quarters.
Yeah, certainly the reaction we saw in Western Alliance following its earnings is quite different from what we were seeing today with First Republic. David, finally, is the banking crisis over? Should people not be concerned about further sort of contagion, not just among, I don't know how much you can speak to more broadly, but even beyond the regional banks? Are there still areas that people should be watching as potentially risky?
I'd say the acute stress and panic of what transpired in early March is indeed behind us. All of the regional banks, the larger ones, reported last week, and the deposit outflows were less bad than feared. So I would say the acute stress is behind us. The next sort of potential shoe to drop is on the credit quality front, because now that the banks are reining in their lending availability and capacity, the key will be how much does the economy slow? How much do credit costs increase as borrowers are unable to, service their loans? And commercial real estate is making a lot of headlines, and deservedly so, especially in the office market. So that's what people are really going to be looking for going forward. But that's going to play out over the next 12 to 18 months, whereas the recent crisis of early March, I think, is behind us.
All right, we'll stay on top of all of that. David Chiaverini, thank you so much. Wedbush Securities Managing Director, really appreciate your perspective this morning.
Thank you.